Good day, fellow investors. The psychology of investing. The thing is that when stocks go up, people find reason to have those stocks go even higher, and the opposite is true when a stock goes down. We have recently discussed Dollar General, how it is cheap as the stock is down, of course, and there were so many comments about tariffs that will destroy Dollar G as cheap Chinese good, destroy tariffs, don't invest there, tariff from China, higher inflation on a retailer. One comment here, closely investor sentiment is negative, therefore nobody discusses the potential for long-term holders. And as the stock is down, I think 90% of the comments were negative on China tariffs. But check this, Apple, 95% of the iPhones and the materials is produced in China. There is no tariffs panic. Same situation, same fear. Here with Apple the stocks goes up, and therefore AI, whatever, no fears, no risks from tariffs. Dollar General, the stock goes down. Let's find something that will justify the stock price going down. It's very important to be careful how your mind plays tricks in relation to stock prices. Whenever I do an Apple or a Dollar General, there were no comments about cash flows. No comments about cash flows, no comments about how much you make from owning the business. So Apple, 100 billion in cash flows. Nobody is commenting, okay, I will make 100 billion if I pay now 3.5 trillion. That's a little bit less than 3%, a little bit of growth. I'm happy with that. No, people are, oh, will the stock go up on AI or will the stock go down on tariffs or whatever? And this is something we need to find a differentiation from the mindset playing games on our perception of value and price. And for that, we have created this value investing quadrant where we look at earnings. Apple, 3%. Dollar General, 10% cash flows. Over time, I don't know where the stock will go, but I'm looking at building at portfolios with earnings. This is one of my first videos 7 years ago. The market irrationality explained on Kroger. Kroger will beat the S&P 500 because the earnings were there. From that video, Kroger did 124%. The S&P 500 did 112%. Okay, Kroger wins with the dividend, but that was not the issue here. The S&P 500 went up on expansion of valuation of whatever. Kroger compounded that earnings. And the market is a voting machine in a short term, the weighing machine in a long term. The problem is that you don't know whether the short term here is 10 years and the weighing will happen after 20 years. This is the problem. It can be 6 months, it can be 10 years. That's impossible to know, but it is a decision that one has to make. Am I going to invest based on voting, where the stock will go, or based on weighing how I compound those earnings in my portfolio? That's the whole difference between value investing and whatever else is there. And if you want more value investing, subscribe to this channel. Thanks for watching. I'll see you in the next video.